IRS red flags revealed. Don't get audited. Stick around to the end because you never know which situation may benefit you just by understanding what they may be looking for. Now, I know this article says for retirees, but I promise you, each of these items are not just for retirees. These are just in general so you can have an understanding. Plus, I'll elaborate on some that could put you in the best position. In addition to that, if you want access to my team of experts who will help you maximize your refund legally, but also put you in a position to where you're able to minimize your tax deductions and not get overcharged fees, then it'll be a link down below. So 10 IRS red flags in 2025 and really in general. So they talk about retirees, but I'm letting you know it's much more than just retirees when it comes to escaping the IRS audit machine. So that being said, let's dive straight in. As you bask in your retirement years, traveling, enjoying dinners with your friends, spending time with family, finding new hobbies, and returning to old ones, you may think your chances of IRS audit would be low. After all, why would the IRS examine tax returns that you file in your golden years? And generally, you would be right. But again, this is more than just about the IRS. So over the past few years, the IRS has been auditing significantly less than 1% of all tax returns filed by individuals. The audit rate is likely less for retirees who don't claim as many refundable credits as other taxpayers whose returns are generally not very complicated. However, not all retirees are in the clear in terms of the IRS audit. So let's jump straight to the list. I want to get straight to the list so we can break some things down and you get an understanding. So number one, failing to report all taxable income. This is applicable across the board. Failing to report all taxable income because so many people, they feel like if they make a certain amount of money, they can just say, keep it under the table. I made that cash, or I got that Cash App, or I got that Zelle. No, you want to report all taxable income. And it's not a matter of you not reporting it and you thinking, oh, if I report it, I'm going to fall into a higher tax bracket. Yes, that's possible. But what many people fail to realize, if it's taxable income and you report it, that also comes with tax deductions. Taxable incomes is partnered up with tax deductions. So that means if it was taxable income, then you also may have a ton of tax deductions associated with how you made that money that can legally lower your tax liability across all of your income. It benefits all of your income. So if you made aside $20,000 and you do the math and you realize, oh, I had $10,000 in tax deductions associated with that 20, then not only does it help that 20, it helps the other 50 you may have made, from your primary source of income. So understand that. And understanding tax deduction is key, and having tax preparation people or tax preparers, tax experts who understand and are not afraid to apply the tax law, the tax code, benefits you the most. So you definitely want to click that link below if you have not already filed your taxes. That being said, let's dive into what they're saying. They say failing to report taxable income from wages, dividends, pensions, IRA distributions, Social Security benefits, and other sources will almost certainly draw unwanted attention from the IRS. The IRS gets copies of 1099s and W-2s you receive. So if you received the 1099, you could bet your bottom dollar that the IRS received it because they had to report it to the IRS. And the reason why they're submitting the 1099, because it's a tax deduction to them. So if they paid you, then it's a good chance that it's a tax deduction for them. So they're reporting it to the IRS, and now you not reporting it, it trickles down to you as the person who stopped the flow of where the income or cash flow went. So you definitely want to report it if you receive 1099s and especially W-2. So this includes 1099Rs, basically reporting payouts from retirement plans such as pensions, 401ks, and IRAs. SSA 1099 reporting Social Security benefits, and 1099K reporting online payments such as PayPal, Airbnb, and Etsy. And that's a big one. That 1099K, when you get that from a platform like a PayPal, Etsy, Airbnb, you want to report that because, like I stated, it's partnered up with tax deductions. Just from the mere fact that we benefit from the tax codes, and those who make income that are self-employed business, you have some type of side project, so to speak, you qualify for tax deduction. Do not leave that on the table. So Airbnb, for example, say you had an Airbnb, good and well you had a lot of tax deductions associated with that because it took some money to make some money. It took some money to make some money. So the money that it took to make the money that you made is tax deductible, oftentimes up to 100%. And so many people leave off the PayPal deductions because they're like, that's, no big deal. No, You want to claim that. I make sure I tally up all of my deductions, because you know why? When it comes to PayPal, if you get paid via PayPal and it's an actual payment in the form of an invoice or a transaction, PayPal is charging those fees. So if PayPal is charging fees, each and every fee is tax deductible. Why would you leave that on the table? Every fee is tax deductible. So do not leave that on the table. Let's keep going. This year, a 1099-K is required to be sent to individuals who in 2024 receive $5,000 or more in payments from these third-party settlement networks from providing goods and or services. Now, it used to be $600. So $5,000 is a new one for me. So if this applies to you, be sure that you receive your 1099-K form before you file your return. The threshold for 2025 1099-K mailed out in 2026 is $2,500. The IRS computers cross-check the numbers on the 1099 and W-2 forms with the income shown on your return. A mismatch sends up a red flag and causes the IRS computers to spit out a notice that the IRS will send you. So be sure to report all income, whether you receive a form such as a 1099 or not. Now, just to make sure this video is not too long, what I'm going to do is blow through all of the red flags. Then I'm going to come back and briefly explain all of the red flags in a way that best benefits you. So bear with me. Number 2, making a lot of money. Making a lot of money can position you for IRS audit. Because if it looks like a big jump from your previous year, they're like, hold on, something changed. And it could have just been, business was good, or you got better at something, or it was a need-based item that you were able to provide, or a service that you were able to provide. But it still can trigger an audit, and we'll double back on that one. Number 3, claiming large deductions or losses. So if you're claiming large deductions or losses, that could trigger an audit. Now, I don't want you to be fearful or terrified of claiming large deductions, because if it took that money to make the money that you made, then by all means, you need to claim that deduction. I'm all for you rightfully claiming tax deductions. If it took your internet service in order to create the content that you created or market the product that you marketed, then yes, you should take that tax deduction. If it took you traveling to a certain place and you were able to do certain business or create some content, then yes, you should be claiming those travel expenses as well as deductions. If it took you being able to or having to pay for a certain prescription or professional fees, then yes, you should be writing that off. So regardless of them saying large deductions, you should be writing those things off, but be mindful that it could trigger an audit. But it's all about you keeping your records. If you have the records to justify whatever it is that you claim, then you should be good. So don't worry about that. Don't let that, bother you as much. Gambling winnings and losses. So that is what it is. If they see gambling winnings and losses, then, that could play a part and trigger those audits. Number 5, not taking required minimum distribution. So this is for retirees specifically. Basically, the IRS wants to be sure that owners of IRAs and participants of 401k and other workplace retirement plans are properly taking and reporting their required minimum distributions. So that's in and of itself. They're looking at it like, hold on, if you're not taking a required minimum distribution, what's going on? So it may trigger it, but that's just that. Taking an early distribution from an IRA or 401k. So sometimes people may take an early distribution because they needed the money and wanted to tap into it. Then they may trigger it because it's like, okay, hold on, where did this side piece of cash flow come from that they took a penalty in order to be able to access? It may trigger something. So that's that. Number 7, claiming large charitable deductions. And some people do this. They feel as though, well, I donated, I did this, I did that. Well, if you try to maximize your charitable deductions, usually it's capped off at a certain amount, especially if you're filing on the Schedule A. That's a whole nother conversation. But claiming large charitable deductions can trigger an audit. Number 8, running a business. Again, like I stated, running a business comes with tax deductions, but don't shy away from it just because they say it can trigger an audit, because it's all about the records you keep. You knew it took money to make money. They know in this world it takes money to make money, and a lot of times you might not make money, but you've already shelled out or spent a decent amount of it before you even were profitable. So knowing that fact, then that positions you to understand that, hey, I need to make sure that I keep my records, and I'm not afraid to take these tax deductions because I'm in already more than I've made, just because I had to invest in some knowledge. I had to invest in some products. I had to invest in some materials, some supplies, something in order to make the money. So Schedule C is a treasure trove for tax deductions for self-employed individuals, which is what I stated. It's a treasure trove, meaning that it's an abundance of tax deductions that come from you having a business and filing on the Schedule C. However, it's also a gold mine for IRS agents who know from experience that self-employed people sometimes claim excessive deductions and don't report all of their income. See, they're basing it on that. So those two things go together. They may take all these deductions but not report all the income. Report your income, but take all of the deductions and have records. Emphasis on the records. The IRS looks at both high grossing sole proprietorships and smaller ones. Sole proprietor reporting at least $100,000 of gross receipts on the Schedule C. Cash-intensive businesses and business owners who report a substantial loss and have income from other sources such as wages or retirement income have a higher audit risk. If you're semi-retired but still running your own business, or if you have a side business in your golden years, be sure to accurately report all your income and keep good records and receipts to document expenses you claim on your return. That's retirement or not. I've been saying records, receipts equal cash. Keep those documents because it can help you. And there are different tools and things that you can use. We have a software that allows people to track their receipts, take pictures of their receipts. I even have a scanner at home that scans receipts. I'm able to lay those receipts down. It scans it, it digitizes it basically. And, that's been helpful for me as well, because they say that sloppy record keeping makes it easy for a revenue agent to disallow your deduction. So record keeping is key and critical. But when you're reporting all of your income, it proves that you have less to hide, especially if primarily or all of your income is coming from a business or sole proprietorship, and you're relying on their money. Then they know this person is really doing business. They're not just doing it as a hobby. They're not just playing around with it. They are in pursuit of a profit because this is their primary source of income or only source of income or main source of income. Number 9, deducting hobby losses on Schedule C. This catches a lot of people up. So your chances of winning the audit lottery increase if you file a Schedule C with large losses from an activity that might be a hobby, such as dog breeding, jewelry making, horse races, or corner stamp collecting. Your audit risk grows further if you have multiple years of hobby losses and lots of income from other sources. So be careful if your retirement pursuits include trying to convert a hobby into a money-making venture. Now, a lot of these can be businesses, but they may deem it as a hobby if it just looks as though you just took multiple losses and not showing a lot of income. So you're just going to have to be strategic and understanding that, hey, let me position myself to know that I'm always trying to make progress. A couple of things that help. When they see that you're making obvious progress on a year-to-year basis, that's proof that, okay, they're trying to aim and strive for more profits. And then when they see that it is your primary income, so say, for example, you were working a job and you were doing this on the side. Your income on the side business that you were doing increased over time, and then eventually you left the job, and now that becomes your primary source of income. That trail of progression serves as a form of protection in the sense that they see, okay, this is not a hobby. They were striving for more. So no matter how they try to box it in and claim it as a hobby, if you're constantly making progress, it proves otherwise, that you're in pursuit of a profit. So to be eligible to deduct a loss, you must be running the activity in a business-like manner and have reasonable expectations of making a profit. Didn't I just say that? If your activity generates profits 3 out of every 5 years or 2 out of every 7 years for horse breeding, the law presumes that you're in business to make a profit unless the IRS establishes otherwise. So if you're profitable more times than not, that's beneficial. The analysis is trickier if you can't meet these safe harbors. That's because the determination of whether an activity is properly categorized as a hobby or a business is then based on each taxpayer's facts and circumstances. So it's whatever you can prove, your documentation and the circumstances. One of them being, are you primarily dependent on this income, so to speak? And they didn't say that, but, I just know that to be true. And number 10, claiming large rental losses. Do you own some rental properties that help to provide a consistent revenue stream in your retirement years? Maybe you regularly claim large depreciation deductions and other write-offs on Schedule E that end up generating a tax loss from your rental activity. Claiming a large rental loss can command the IRS's attention, especially if the loss helps to offset income from other sources that you report on your return. And a lot of people use real estate and large rental properties to offset income in other areas, which it makes sense. It's strategic to do so, but that's not to say that wouldn't trigger an audit. And I'm not here to say that you shouldn't do that, because it's all about leveraging what we have available. If the tax codes are here to allow us to legally minimize our taxes and maximize our tax refund and or put ourselves in a position to not owe, then that's what it's all about. That's what America is. It's actually un-American to pay taxes. But you can legally find ways to strategically lower your tax liability by having the proper record keeping. So I won't read this verbatim word for word. I know I said I would go back to a couple, but I think you get the point in terms of making sure that you pay attention to these things. If you made a lot of money, then don't be afraid to report it. But if it's a big jump in income from your previous years, then it might trigger something, and that's okay. And it's not that you have to be terrified of an audit. It's a matter of just having the records to justify it. It's a matter of having a tax team, a group of tax experts that can position you to be confident in what you're claiming. And if you want access to a team of experts who have a plethora of knowledge and tools and know-how and confidence in order to help you properly apply the tax code and give you guidance on how to make sure that you're on point, then click the available link below. That's all I got for this video. Mr. Smith signing out. Salute.